So welcome everyone, and thank you so much for joining this today. So option trading is one of the topics we are really excited about, and we can't wait for it to get started today. So before starting, I would like to introduce ourselves. So I'm Taran Nandakumar. I work as a relationship manager at Algates Financials. So we have Mrs. Nidhi Verma, who's one of our directors, and she too works at Algates Financials. So without any further delay, let us take a quick look at the common option trading mistakes that we would be covering in today's webinar. So ma'am, these are the mistakes that we generally come across. And I would like you to elaborate on them so that our viewers today get an idea what they're getting into if they're a beginner in option trading.
Yeah, good morning, everyone. Thank you for joining in, and we appreciate that you are giving your time to us. And thank you, Tarun, for the introduction. So this webinar is designed for people who are new to option trading, but we hope that even some of you who have been trading in options for some time, there will be some takeaways for you as well. But we would try to keep the language as simple as possible for a layman to understand, like for a beginner to understand what are the concepts. And we will be dealing more in concepts rather than going in numbers, so that you have an idea of what happens when people trade in options. So these are the classic pitfalls which generally happen, and we are only talking about 7 here because 7 is a good number to tackle in this much of time, whatever is the time frame. So let's just begin with the first one. So the most important thing which we have observed, the most common thing which we have observed among clients and others who trade in options, like people whom we talk to, is that they do not have a strategy which matches their outlook. So this is the most common thing, that the whatever outlook they have, the strategy which they implement, they usually do not have any strategy. Either they are trading based on hearsay or what others are doing. So this is what happens most importantly. So what makes the strategy very important? Why is it important to choose the right strategy? This is important because when you do not know that what you want to do or where you want to go, then you do not know what steps to take. So that is what happens usually. So it is important to choose a strategy because there are a couple of things. First is that profit maximization. So you always, of course, are trading because ultimately you want to make profit from the trade, right? So when you have the right strategy, then you will be able to calculate well in advance that what would be your maximum profit from that particular trade. So it is important to know in advance that what you can expect from a particular trade. And also then there is the amount of risk which you are taking. So if you know your strategy, then you would know that what is the kind of risk which you are taking, because options by nature are very risky instruments. So knowing what you are getting into and knowing the kind of risk which options offer, you will be able to know in advance that what you are getting into. So the right strategy is the foremost important thing. And if you know that, then of course it improves your odds at success, like getting the success. So the probability of success improves if you are implementing the right strategy, if you are implementing the strategy which suits you and your outlook. So what are the steps to decide what is the right strategy for you? So first important thing is to develop an outlook. Okay, so if suppose you are saying that you think that the market is going to go up or a particular stock is going to go up, if you are observing that you are observing a trend that a particular stock is going up in the recent times, it is in an uptrend, and you believe that that particular stock will continue to have that trend for some time in future, then that is an outlook. Basically you are saying that you are bullish on that particular stock. So first important thing is to develop an outlook, and then decide how much risk is appropriate for your account. Okay, how much risk you can take, what is the capital which you are putting into trading. and then you analyze multiple strategies. Suppose you are bullish on the stock, then of course that time only you have to eliminate all the strategies which are bearish strategies. So then you are left with only strategies which are, say, bullish or neutral. So then after that you have to decide that which one will suit you. So you have to analyze multiple strategies based on your outlook, and then you have to ultimately choose one based on your style and based on the risk which you are going to take. So the important thing is that many people ask is how to develop an outlook. What is the starting point? How do I develop an outlook for a stock or for the market in general or for an index? How do I develop an outlook? So there are two main things here. So most of you would be knowing about this, but just let's look at this once. So the starting point is technical analysis. So I mean, this is basically a fancy way of saying that someone is analyzing charts. Okay, so the charts will show you the historical stock prices, of course, and then they will show you trends, and then on the basis of the trends you can determine what are the support levels and what are the resistance levels for particular stock or index. Then you can see the trends, and then there are a host of indicators which will tell you whether this stock is likely to go up or likely to go down, or whether this is going to be I mean the time it is going to be in a particular range, and it is going to be range bound for quite some time. So based on that you can decide, you can have an outlook, you can develop a sense that where it is going to be. You basically, it is an outlook, it is an opinion. You believe that this is going to happen, but it will happen or not, we do not know. So by an outlook we mean an opinion on a particular stock or a particular index. Okay, and then there is fundamental analysis on the other side of the spectrum. So here we do not see the stock prices. Rather than that, we see what is there in the I mean fundamentals of the company, what is happening. We analyze balance sheet or income statement, we see earnings, we see what is the PE ratio, and what are the current business trends, what are the macroeconomic factors, and then we have some sort of idea that where the stock is likely to go in the near future or even in the distant future. So you don't have to do only technical or only fundamental. Most of the traders, what they do is that they do a combination of both, a little bit of both, and then they determine like a particular opinion. Then they come to formulate an opinion on that stock or that index, and then they can that could be the starting point to start I mean placing a trade. When you have an opinion, that is basically the starting point, when you believe that this is going to happen in future, and that belief is supported by your technical and fundamental analysis of that stock. So
So coming back to the prime component, can you talk about choosing the wrong expiry or maybe even the right expiry? Because that certainly has to be introduced to option trading as beginners.
So Tarun, actually, what happens is that when we trade in options, when anybody trade in options, then they do not trade only in the direction, but there are so many components in the price of an option. Suppose a person or trader is only trading in equities, then when he is having only an outlook on the direction of where the stock price is going, then he can be a good trader only. He can be a good trader because there only you need to know the direction, that where the stock is going to go in future. Because when you are trading in stocks are theoretically perpetual assets, right? They do not have a time frame attached to it. So if you have a sense of direction in terms of the price movements, you can be a successful trader when you are only trading in equities or investing in equities even in long term. But when you are trading in options, there are many components to option price, and you have to consider those things also when you are placing a trade. Before placing the trade, you need to know what affects the option price. So option by nature are finite assets. They have an expiry, they will mature, after that they will cease to exist. So there is of course a time component in it, which is very crucial. Okay. And another component, which is the most, I mean, the least understood concept, is volatility. Okay, so since they are finite assets and they have limited time, the volatility in the stock price also affects the price, the premium of an option in a great way. So when you are trading in option, you need to understand not only the direction of the movement of stock prices, whether you are bearish or bullish on the underlying stock. You also need to understand what is the time frame which you are having, what is the maturity, what is the expiry of that trade, and till when you are planning to be in that trade, which may not be actually the expiry. Like, you don't have to be in the trade till the expiry, right? You can close your trade well before that, or it depends on your purpose of the trade, or what you think, or whether your that outlook is unfolded within that particular time or not. And the volatility component is also very important, because that determines whether a particular option is cheap or expensive at a particular time. Increased volatility of an increased volatility in the stock price will always increase the option premium, and all else, or everything else is equal, then if the volatility increases, then option prices will increase, which is a positive for option writers. By option writers, I mean people who are selling the options freshly. Okay. And it is a negative for option buyers, because when the volatility decreases, the price will just come down, because the volatility has come down. Okay, so if you are on the buying side of an option, then you have to be very careful of even the volatility of options. So let us just go to expiry. Like you said, you asked the question, let us just go to the expiry. So what many people do is that they do not choose the appropriate expiry, but please note that there is no right or wrong answer here. It is not that this is the right expiry and only this you have to choose, and this is not the right expiry, but you need to have an idea of what you are selecting and how it is going to impact your trade, okay, your profits or your risk. So by expiry, what happens is you set the time frame for your trade. The maximum time frame will be till expiry, because this is I mean a finite instrument in terms of time. Okay, so when you buy a stock, the ownership doesn't expire until you sell it. You can keep it for how much ever time you want. But when you are buying or selling an option, when you are trading an option, you must agree to an expiry date, and that is a part of the contract, right? So you have to be very careful in what you are choosing, and use the expiries to fit your trading style, whether you are a day trader, or you are a premium seller, or you are a technical trader who is trading based on the charts, or you are an earnings trader. Suppose you are an earnings trader. So earning trader means that you are basically relying on the events where the companies declare results or earnings, and then you expect that because of those results the prices of the stocks will move up or down. So that event has to happen before the contract expires, right? You cannot choose an expiry where it is the expiry date is way beyond that event. Then that would not be the appropriate expiry for that particular I mean style of trading. So it is important that it fits your style of trading, whatever expiry you are choosing, and you are conscious of how it affects the price and your I mean profit potential. So when choosing expiry, you have to be like considering certain things, like forecasting the length of the trade, like how long you are going to be in the trade, whether you are going to close this trade in a couple of days or you are going to keep it for long term, like till the expiry. It does not have to be that you keep the trade till expiry. You can close it well before that, right? So what you are going to do with the trade, what is your opinion on that? Whether you are going to do monthly options or you are going to do weekly options, because there will be so many components, there will be they will have different liquidity, and sometimes the strike prices which are available in monthly may not be available in weekly. And then you have to see time decay, that how much time is remaining, because that will definitely impact the premium which you are paying, the price of the option, because time component is a big component in option pricing. Then binary events are basically, I mentioned the results of the company or something, like some announcement is going to happen about the company, which can take the price of the stock either way, like it can take it in a uptrend, or it can, the price of the underlying stock can fall depending on what news comes out. So if any news is expected from a particular company, any announcement is being expected, so these are binary events, whether they are going to declare results in coming days. So these are binary events. After the declaration, the price might move even downward or upward. Then of course the volatility in the underlying stock, whether the market is volatile, whether the stock is volatile, or is it stable for quite some time, it is having a smooth ride. So these things we need to consider. Okay, so what are the reasons that people choose wrong expiry? First is that they do not have any particular outlook, like they don't have an outlook, they are not sure what they are going to do, what is going to happen in the market, they are not sure about that. And another thing is they want to, they are they don't want to take loss, right? Their aversion to loss outweighs other factors. Like some people are, I don't want to take loss, some people are like, I don't want to take loss, whatever happens, but I don't want to take loss. So they outweigh all the other factors. When you are trading in risky assets, you cannot say that I will not take loss in this particular trade, because that will happen. But you have to consider, so you have to consider all the other factors. Okay, so this is a thing, like we have to consider all the other factors and then choose our expiry. And another thing is liquidity. This is very important. So let's look at the next slide. What is happening here? You see, this is just a screenshot of actual option chain from NSE website. So what is happening here is, if you see in the right hand side, calls and puts, two screenshots are there. So the first one, you see, the expiry is 28 July 2022, so which is the end of this month. Okay, and when you see the volume in that particular option is very huge compared to what is there for the next month expiry, like 25th August 2022. So you see the change in the volume, like 6,000 plus, and the next month option itself is only 723. So how it is impacting the price, or how it is impacting your trade, the sheer volume. And also you see the open interest, the OI, the first column. Okay, open interest, the open interest in the first trade is more than 1,000, and first expiry, and the open interest in the next one is only 412. Okay, so how it is going to impact you? Now you have to see the difference between the bid and the ask price. Okay, so you see the bid and the ask price, the first row, which is of 28 July 2022 expiry. You see the difference between the bid and the ask of that option is only 30 paisa, right? And when you go to the next row, the difference increases, it becomes more than 1 rupee. And the next one of September expiry, there is basically nobody is trading in that. Okay, so it is not available practically. So this is what I meant to say, that when the liquidity is more, the pricing is more efficient. Okay, the difference between the bid and the ask price will be lesser, and it will be easy to place the trade at the price which you want. Okay, so even I mean, when you are trading in huge volumes, when you are doing multiple contracts, then these things matter. Even the price difference of 2 rupees or 3 rupees in the bid and ask matters. So it is always advisable to do trade in options which are more liquid, because the pricing there is more efficient, the difference between the bid and the ask will be less, and placing the trade will be more smooth. You can place the trade at your I mean, whatever price you want to place, you can place the trade, and it is more likely to go smoothly. So trading in less liquid options may impact the premium, not only when you're getting in, also when you're getting out. When you're getting in into the trade, then also it impacts your premium, and when you're getting out also, then also it I mean impacts. So it impacts both ways. So it is always advisable to trade in instruments which are liquid, because it is ultimately going to affect your price, your buying and selling prices. So how you will determine, you have to see basically the volume and the open interest, and you have to see the difference between the bid and the ask price. And then of course the contracts which are near expiry will be more liquid compared to contracts which are farther in expiry. So that is also there. And there can be other factors also which can affect the liquidity of I mean options.
So this takes us to another point that we had in our slide for today. That is how the amount of contract and position sizing can start playing a role in how much money we are going to make. So also choosing a wrong position size can lead to quite a few problems.
Yeah, see, what happens is that what we have seen is that people do not know that how much amount they are going to commit, and how much, I mean, how many options they would like to buy. When generally people are starting, they are beginners in option trading. Most of the people start very small. They will be doing one contract at a time, which is the right way. There is nothing wrong in it, right? Which is the right way, because when you are a beginner, you don't know, you are learning. So that is the right way. But what happens is, when we go further, when we have had an experience in option trading, when we go further, what happens is people start making more mistakes. What they do is that, suppose they make profits in, say, 2 or 3 trades continuously, then they get overconfident, and in the next trade they suddenly increase the number of contracts from, say, 1 to 5. And in that contract, if they lose, then what happens? Whatever profit they made in the first 2 3 contracts, where it went in their way, like it went the way they wanted, the entire profit is wiped out, right? Because they suddenly increase the contract size from 1 to 5 or 1 to 10, right? So this is what happens. People get overconfident. Or some people are like, they start small and they are always very scared, and they don't gain confidence. Even if they are trading smoothly, everything is going fine, and they continue to trade very small quantity, even going further. So even if they improve, they understand how option pricing works, they improve as a trader, they do not increase the position, or the they do not increase their size. So what happens is that they are there, they are investing their time, they are putting their capital, but the profits which they are getting are very small. So they do not gain basically confidence. So all these things happen. So we have to be very careful. We do not have to be overconfident. What one can do is, there is, it depends on the person also who is trading. But what people can do is that they start a small, that is a good thing. And then as they gain more confidence, as they become seasoned trader, they gradually increase the size of their trade. Okay, and also it depends on how much capital they are willing to allocate, okay, on a one particular trade. So if suppose somebody, a good way to decide it is that, you are going to allocate 1 or 2% of your entire capital you are going to risk on a particular trade. You're not going to risk more than that on one particular trade. So whatever is your capital, suppose you are starting with say 1 lakh rupees, then you just keep 2 to 3% of that money for one particular trade to allocate as a risk factor. Okay. Another option is that you use a constant rupee value, that I will always allocate to one trade say this much amount of money, and I am not going to allocate more than that or less than that. Around that I will keep. Okay, so this is very difficult to implement, but yes, you can implement it, and what it will do is it will reduce the emotional impact of your decision. Suppose in the past 2-3 trades have gone in your favor and you become very energetic and very excited and put the entire capital or 50% of your capital in the next trade, because you are simply excited and happy about the previous trades in which you made profit, and that trade goes against you and then the capital is wiped out. So that is all not a good idea at all. Allocate some amount in terms of fraction or in terms of rupee value, and keep it consistent. As you grow as a trader, then you can when your capital increases, when your experience also increases, then you can change these values, or you can decide on it how to reevaluate them. But I mean, to start with, this is a good idea. And also another thing is that some traders will be concentrating on one particular stock or index, like some will be only doing Nifty, or some will be only doing Bank Nifty, or 1 or 2 stocks. But if you spot opportunity in other places, then you have to have the money to I mean, make use of that. So it is not a very great idea to be always concentrated in one thing. It is better to diversify. You can just track say 5 or 10 stocks which are on your radar, and decide where the opportunity is and trade in those options. So this is also a good idea. So another important thing is risk considerations. So what we have to do basically is that when we are into options trading, then more than anything else, we have to be risk managers, because as soon as you place the trade, right, as soon as you place the trade, your trade is executed, your risk starts. Profit might come in future or it might not come. Okay, but the risk is from that second, that moment when your trade is executed. So you have to be always wearing that risk manager's cap and think in that way, that what is the risk which I am going to take if I do this trade. And that thing you have to be aware of even before placing the trade, not only after placing the trade. You have to be aware that what is the risk we are going to take, because when you are aware in advance, then when you see that the trade is going against you and you are seeing red in your screen, then you are already prepared to tackle that situation. You know what to do. You already know in advance, you have already decided that, okay, I have placed this trade at this price. If my loss goes to this level, I will exit this trade. Or if my profit goes to this level, I will exit this trade. So even if in your screen there is a red, you are in a more sensible position to take decision at that time, what to do, right? Whether to keep this or whether to hold this or whether to sell it off at that time. Because as soon as you are entering into it, the risk is starting. So this is very important. What people do is they think of the profit potential first. This is a very big mistake which most of the people do. They think of the potential profit first, and the risk part, they know that this risk is there, but that is not the first thing which they think of. So this can help them manage the trades better, and even when their things are going against them, then they will be in a situation where they will not panic and they will be focused and know how to manage the trade in the current conditions. So this is very important when you are doing option trading. And what will happen is that it will reduce the emotional attachment also, because we are humans, we are all emotional beings, right? And obviously when we see red, when things go against us, we panic, we do not know at that time what to do, we cannot take rational decisions. So if that decision is taken in advance when we do not have risk, then we are in a situation that, okay, we know that this happens, then we will do this. So then we are in a situation where we can take the decision without being very emotionally attached to it. So this also reduces the volatility in the portfolio. So we have to be managing the risk properly more than managing the profit. If we manage the risk, then we can be a long-term trader. I mean, we can be trading in the long term, and we can continue to make some consistent profits over a period of time.
So like another risk to all option traders, especially those are new, is that not understanding all the components which affect the option price. So volatility. So this is one of the major ones. Can you talk about this and how does it affect an option price? And how can one
Yeah.
tackle this also?
Yeah, see, this is as I told earlier also, this is the least understood. I mean, I think the concept in option pricing, but this affects the option pricing in a big way. So volatility is basically, what volatility is, when there is a lot of quick changes in the price of a particular stock, that is volatility. But here what we are talking about is implied volatility. When you see an option chain, you will see that I mean, there will be a column with IV. If you can see the screenshot on the right hand side, I have highlighted it with blue color. So that is basically implied volatility. What does it measure? What is it? What is implied volatility in an option? So it measures what the market expects volatility of the security in future, based on the premiums of option contracts for that security. So it is a measure of where, how the stock price will move, the underlying stock price will move in future based on the pricing of the option itself. Okay, so it is annualized percentage of future expected move. So what will be the future expected move, that we have to just convert it into annualized percentage. And another important thing is that this is dynamic. Suppose when you are placing a trade, there will be an IV for a particular, that particular option in which you are placing the trade. But as you go forward in time, this will not remain the same. Okay, if you check the next day or next hour or next day or after a couple of days or at the time of expiry, this IV will be different, because it is dynamic in nature, it is not static. It changes with the option prices based on the demand and supply for the contracts. Okay, so here it is 20.56. So what does it mean? It means that the market is expecting 20.56% annualized move in the underlying stock price based on the option contract. So this is something which affects the option price, how we will see in the this slide. So what happens is that, suppose the market participants are expecting a particular stock to have, I mean, market participants expect larger future movements in a particular stock. They are expecting larger movements in one particular stock. So what happens is they start buying options. Why? Of that particular stock, with that stock as an underlying asset, the participants will buy options. Why? Because they are, first thing is speculating, they are expecting larger move in the underlying stock, so they are thinking that they will make money, good money, if they are buying options. Or for protection, suppose they are having that particular stock, and if it is going in against their position, then they want to hedge it, so they will start buying options. Okay, so the open interest in those options will increase with that particular stock as underlying. So open interest will increase, there will be huge buying pressure. Then what will happen is, this huge buying pressure will create high demand for option contracts with that particular underlying stock. And then the IV levels of those options will increase. In that option chain, you will see that IV levels are increasing for all options in that particular option chain for that underlying stock. So IV levels will increase, then what will happen? Those options will become more expensive. They will have higher premiums. So this is how implied volatility will affect the option price. And if the implied volatility decreases, then the options will be little cheaper, the premiums will be little lesser. So this is what happens, and many of the option traders don't understand this concept, and they suffer because of this. So what happens? How can you determine whether a specific stock's IV is relatively expensive? How will you determine that? Okay, there are some tools, but as I said, I don't want to be very technical. I just want to give the viewers an idea that these are the things which will impact the option prices, so that they are aware and they are more mindful when they are doing trades in future. So let's just look at how this works, how it happens. How will you know that it is relatively expensive? So you can just compare the IV data with the historical data. You can see, if you have traded in options for say last 6 months or 1 year, then you can just follow that option chain in NSE website, and then you can see that like how historically the IV is moving, and you can identify potentially high or low levels. So you can see that how Nifty option chain IV is moving over the time, how Bank Nifty option chain IVs are moving. So if you are doing stock options, say 5 or 10 stock options which you are regularly doing, then you can just keep a tab on that over time and see that how the volatility is moving. And then you can identify the convergence and divergence between HV and IV. HV is historical volatility and IV is implied volatility. Historical volatility is basically what historically has already happened. Okay, so another important point here is that volatility in finance is a concept which is considers most mean reverting concept. Okay, most mean reverting idea in finance. So what happens is that it will tend to move towards a particular mean. It will have a value which will be a mean, and it will try to tend to move towards that. When it goes very high, then it will again try to come back to that level. When it goes very low, then also it will try to come back to that level. So if you are able to identify that, okay, this particular option chain, the IV levels remain between, say, remain in this particular range, then you can see that if they are on the higher side at a particular time, or if they are on the lower side. So if they are on the higher side, then you can expect them to come down, and come back to the mean. So this is another way of identifying. You can just take a look and identify. But there are some tools which will clearly tell you, there are some tools which will clearly tell you that whether it is very high, how much high it is, whether it is going to make even higher highs. So there are tools available in the market, but they would not be free tools. You have to pay and then get them, and there would be some Excel tools also. So you can check them out if you are going so much deeper into it. You can check them out. So how does it matter? Let's just take a look at an example. So this is just a theoretical example. This is not an actual example. So I've just taken it. So what happens is, suppose a stock is there. It is trading at XYZ stock is there. It is trading at ₹1,000. Okay, and you as a trader are expecting that it will move up by 100 rupees, and so you buy XYZ 1060 call option at ₹120. Okay, now what happens is that in a particular after a certain period of time, the exact move happens. What you thought exactly happens. Your outlook unfolds actually. Then what happens? The stock has come to 1100 rupees. What will happen now? What you see that your call option which you bought, that 1060 call option, is only trading at 75. So what happens here? Your outlook actually unfolds. You were right that stock is going to go up by 100 rupees, and it actually went up by 100 rupees within a specified time also. But where is your option? You bought at 120 and now it is at 75. So you made a loss of 45 rupees already on that trade. So what happened? Why it happened? It happened, maybe the chances are that when you bought that option, the implied volatility was very high at that time. So the option premium was very high, and now the implied volatility has come down, so that has impacted the option price, and the option price has come down, the premiums have come down because of that. So you see, everything has gone right, everything has gone right, it is gone in your favor except the volatility part. So here, this is what I mean, some traders would have seen if they have done the trading. But though this is a just a theoretical example, this is what some people who have already done options would have seen happening. So this is how it can affect. So you need to incorporate the idea of implied volatility also in your trade, and you need to see where is the implied volatility, whether it is very high. And another thing is that you can use it in your favor also. It is not something which always has to be taken in a negative way. Some traders can use it in their favor, and some people can avoid trading when it is very high. It depends on how what is your style and what you want to do. So you can trade in volatility, or you want to be just a spectator when volatility is very high. So it depends on you, but it can work in your favor as well.
So is there a way to balance volatility and the risk involved?
Yeah, so let's just this question, let's just come to the fourth point. Like, you can use probability. So what you can do is you can have some sense, I mean, some idea that you will have some idea like this outlook is more likely to unfold in a specified time, and this outlook is less likely to unfold. This outlook is having more probability, right? So generally there will be some strategies which will be low profitability probability strategies, and there will be some strategies which will be high probability strategies. Okay, so what will happen is, in low probability strategy, the profit which you are expecting will be unlimited. Like, there will be huge potential profit because it is less likely to happen, the probability of that happening is less. Okay, so the profit potential will be huge. Okay, and it requires precise timing on the trade. It requires you to be very precise, otherwise it is likely to work against you. Okay, and high probability strategies are strategies which have a smaller and limited profit potential, but you know that these things are more likely to happen, things are going to go in my favor, the chances of that are high. So those are high probability strategies. And what happens is, it allows you to be less right. Even if you go wrong here and there, your loss will also be less. Okay, so it allows you, it gives you that cushion. High probability strategies, so they give you a cushion. Okay, so you can use a probability calculator. Again, you don't have to go in tools. If you can, then well and good, but if you cannot, then just have an idea that what is happening. This is just a screenshot which I have taken, so just take it as a theoretical thing. Okay, and this is very old also. I've just taken from internet, the screenshot which you can see on the right hand side. So what is happening is that, suppose there is a stock which is currently trading at 164.23. On the extreme right hand side you see 164.23, right? Suppose there is a stock which is trading, and we are in the month of, say, time frame is July August 2014. Okay, so the stock is trading at 164. Now, what is the probability that stock will go to 200, or stock will go above 200, or stock will remain within 170? What is the probability? How you will determine? Okay, so assuming that the stock prices are completely random and they follow normal distribution, this has been made. So now suppose that the mean is 164.23. So you see that blue part, which is the hyperbole blue part, you see that what it is showing is that the current stock price is 164.23. So whatever is that blue part, you see the green line here, right? You can see the green line here, right? So what this is showing the time. This is the time frame. Okay, so we are here now. So what is the probability that the stock will remain within this? The stock will remain between 169.30 and 159.19. This is basically 1 sigma. So 1 sigma, 1 sigma, 2 sigma. So this is coming to, as per normal distribution, this will be around 68%. So when we are in say starting of August, we were somewhere in the month of July when the stock price was 164.23. So starting of August, what will happen? There is a 68% chance that the stock price will remain in this slab, between this range. And the next violet line you can see, that is basically 2 sigma, 2 sigma. Okay, so this probability comes to 95%. So there is a 95% chance that the stock price will remain between 174.60 to 150, low on the lower side, 154.36. So this is the chance. So this is basically 95%, and almost 100% chance, near to 100% chance, that on this date, on this time, the stock will be somewhere between 149.68 to 180.06. So this is how it works. So you go further in time, this range increases. Okay, as you are going further in time, if you are going, say, in the end of August, this range is increasing. 68% chance that the stock will remain between 154.77 to 173.81. So as you go further in time, your range increases. So this, you can just be, this is what I want to do is give you an idea that where your stock is, and what is your outlook. If your outlook is farther away, then there is a less probability that that will happen. And if your outlook, if your expected price is nearer to the current price, then there is a more probability that that will happen within a given time frame. So this is the idea which you should have, and this is in both the directions. It can be positive, it can be negative, it can be upside, or it can be downside. So this will also help you it will help you get rid of this directional bias. Okay, so it will be a non-directional thing. Okay, so it can move upside or downside. There is an equal chance, like 50-50, that the stock is now 100 rupees. It can go up also, it can go down also. There is a 50-50 chance. So it will give you a non-directional bias, and it can also help you choose the proper strike selection. So just have an idea that your expectation, where your expectation is, whether it is far away from the current price or it is nearer to the current price. If it is far away, then there is less chance of that happening. If it is nearer, then there is more chance of that happening. And it can be both ways also. So this is how you can determine whether what is the chance of you winning a trade when you are actually placing it, where the stock price is going to be, using just the probabilities.
So, but it's just not probability which comes into picture here. The next thing we can look at is the expiry graph, right?
Yeah, this is also another thing which people can look at. What it does is, basically it says that when you place the trade, when we learn options from the beginning, what we do is that we see that what is going to happen at the time of expiry. Always we are taught, the payoff charts are there. We are taught that, okay, at the time of expiry, if this happens, then this is my profit. If this happens at the time of expiry, this is my loss. But the idea is that you don't have to be in the trade till expiry, right? So this graph can give you an idea where the option will move, how your profit and loss will move during the time of that trade. Okay, so if you can visualize it, okay, then you can know that, okay, during the time of the trade, suppose I place the trade today and the expiry is after say 10 days. So within these 10 days, if the option price is moving from here to there, then what is my expected profit or loss, not just at the expiry. So it makes you more aware about your position, like you are more aware about what is going to happen. It doesn't inform you about your position just today. It, see, if you are not it can blind you to what your position will look tomorrow. So many traders do not hold the position all the way to expiry. So many traders are not doing this, right? They are not holding, they are just exiting that trade somewhere in between. So when you are having this kind of graph, then you have an idea already that how my profit or loss will look like over a period of time throughout the life of that trade. So this can help you. So analyzing T plus zero line can help you by showing your position, if your position needs to be adjusted. So you know that, okay, the trade is not going in my favor, or so it needs to be adjusted. You know that what is your risk and reward ratio by just seeing it, and setting expectations for gain or loss at various price levels. So this can help you. So you should have an idea like how it will look like, not just at expiry, but throughout the life of that trade.
So last but not least, we want everyone to trade with a plan. So that's the most important thing as a trader.
Yeah, so this is the bottom line. This is the most important thing, that we have to trade with a plan. So the plan is the most important thing. How a trading can be beneficial, it can help you, it can take the emotional toll out of trading. If you already have a plan, then you know that, okay, if things are going in my favor, then what I have to do. If things are not going in my favor, then what I have to do. So this plan is to be made before placing the trade, before entering into a particular position. The plan has to be there, and it helps you to consistently construct the trades that meet your needs. So obviously, if you know, then you will get into the trades which meet your needs, and you will just eliminate the other things which the noise around you, and it can help you improve as a trader or an investor. So what should be included in your plan? So these are the 4 things which you should include. First thing is, when you are going to start a position, when you are going to take a new position, what are the conditions for that? Whether you have an outlook, and there can be so many things in this. Okay, so when you will start that particular trade, so you should always have the conditions. If those conditions are not met, then you should not get into that particular trade or that particular contract. And also conditions for choosing the trade, why I am choosing this trade, why I am doing this particular option. You should have your reasons before you get into that. So whether you are doing nifty options or you are doing stock options, why you are choosing that, what is it, what are the criteria which you have set which it is meeting. So that is what has to be there in advance. And what risk you are willing to take, what is the thing which you are risking, how much capital you are putting in it, because that is the most important thing. And how you will gather opportunities, how you will know that this is an opportunity, how you will know that this particular trade only. So where how you will identify opportunities. So these are the things which you need to keep in mind, but they will not come if you are a very beginner. If you have just started, then you can just start very small, because these things will come with time. They cannot come in just one go, but yes, you should have some starting point, of course. So considerations for developing a trading plan. So what you should have before you place the trade, you should ask yourself these questions. Why are you entering this position? What is your idea? Whether you are speculating or you are hedging or you want to make profit, there is a good profit potential. What do you want to do with this? Why you are entering? How much capital are you willing to allocate to this idea? What is the capital? So any idea, you should know that, okay, this much of my capital is going to go in it, because options are very leveraged instruments. So of course you cannot allocate say 50% of your capital to one particular contract. So because if it goes in your if it goes against you, then you can end up losing very big amount. Even 1 or 2 or 3% of movement in stock price can move the option prices by say 50% or something. So you need to know this, and you need to allocate a limited amount to one trade. What are the criteria for entry? What is my criteria for entry? Whether it has met my the outlook. Is it meeting my outlook? The strategy is meeting my outlook. Is it the right selection of a strike price, right selection of maturity? All these things are met or not? What is the size which I am going to take? So these all criteria, whether that trade is meeting or not. What are the criteria for exiting? That also should be there as a part of the plan. So you should always know when you are going to exit, whether it is going in your favor or it is going against you, whether it is upside or downside. You should always have a criteria for exiting that particular trade. If you are unable to answer these questions, then you are not ready to place the trade. So let's just look at the final key takeaways. So this is the last slide from my side. So just these are the final things you can just remember them, so that whatever you heard in the last 1 hour, this is just a gist of that, so that you go with some takeaways which can be useful to you in your future options journey. So you should develop an outlook before thinking about the right strategy. First thing is you should have an outlook. The strategy comes next. So outlook is most important. Outlook is your opinion on the market or on the stock. What you believe is going to happen in future. What is your opinion? What is your belief? You believe that the stock is going to go up, and this is just a belief. It cannot happen also. So you should be mindful of that thing also. Then trade with expiry which makes the most sense for your outlook. Choose the expiry very carefully. Then make sure your strategy also matches your risk tolerance. Whatever risk you can take, don't take too much of risk for one trade. Even if you are very sure, always allocate some particular amount of capital for each trade and be consistent. Suppose you are winning continuously 3-4 trades, then that doesn't mean that you get very excited and put all your capital in one trade, most of the capital in the next trade. So that is not a good idea, because you never know when you lose. So be consistent in risk tolerance, and always in advance decide what your risk tolerance is. If you are completely risk averse person, then this is not options are not good option for you. Be aware of implied volatility and what it means before you trade, and have a trading plan and just stick to your plan over a period of time, whether you are winning or losing. Since already have a plan, you already have a limited capital allocated to it, whether you are winning or losing, stick to your plan. Don't leave it in between, or just don't change your plans very frequently. Don't change your trading plan frequently, because the past results have come in your favor or against you. So whenever you make a plan, just stick to it over a period of time and see whether that is working for you or not. So these are some of the disclosures. So option trading entails significant risk and is not appropriate for all investors. So certain complex option strategies carry additional risk, and whatever charts or screenshots were there, they were for only illustrative purpose. And if you are doing multiple purchases based on strategy, then there will be extra cost. You should be aware of all those things as a option trader. So Tarun, it would be great if you can just tell our viewers something about ourselves, and then we can wrap it up. We can see if any questions are there.
So Algates Financials is like an authorized person of Cholamandalam Securities, so which is one of the leading stockbroking firms in South India. So we deal in bonds, corporate fixed deposit, and even fixed income segments. So Algates Consulting IMF is an insurance marketing firm. So we cater to insurance needs of our clients by providing an advice on life and health insurance solutions available, which is available in the market. So we believe in providing the best service to our clients through dedicated team of relationship managers. So if you need to reach out to us, you can just contact this number, or you can just send an email to us.
So if any questions are there, we can take up. Or Tarun, any questions are there from the viewers?
No, ma'am. There's no questions as of now.
Okay, fine. So thank you for joining us today. And it was great pleasure having you. Please reach out to us. As Tarun said, you can mail us or you can call us, and you can have a look at the upcoming webinars on our website. And if you are interested, if this interests you, you can have a look. And if you are interested, you can register for the upcoming webinars. Thank you so much, and have a great day.
Thank you, everyone.